Getting a mortgage for a condo can be a little tricky. Whether you're looking at condos in Boston, Acton, Worcester, or any other town or city, there are things you need to know. I'm Meredith Spence, the mortgage lady, and I'm going to unpack all of this for you right now. The mortgage industry has developed lending guidelines that are specific to condos. If a condominium doesn't meet these guidelines, then it could be designated as non-warrantable, which means it will be ineligible for many mortgage programs. So here's the challenge. As a buyer, you might not become aware of an issue that would cause your mortgage application to be denied until you'd already spent the money on a home inspection, had an offer accepted, paid for the bank appraisal, given notice to your current landlord, and scheduled your move. Doesn't that sound terrible? Of course it is. So you're probably thinking, how could this happen? It doesn't make any sense. So here's why it could happen. Lending guidelines for condominiums have become so complex that the chances that the realtor and the attorney you choose to work with won't be aware of all the different items that need to be researched up front. In fact, there's a very real possibility that the seller and their realtor might not be aware of a potential issue as well. So I'm not suggesting that you not buy a condominium. There's so many great reasons to live in a condo. You don't have to be responsible for all aspects of the maintenance of your home. You may wish to have access to certain amenities offered by a condominium. And last but not least, a condo may be the most affordable option. So what can you do to protect yourself? You can get educated on the types of things that could pose issues for mortgage financing, and you can choose a mortgage lender who is experienced with condo lending and will be proactive in making sure the condo meets lending guidelines as early in the process as possible, preferably even before you make an offer. So let's get down to the nitty-gritty. What do we need to find out up front? Is the condominium on the list published by Fannie Mae or Freddie Mac as unavailable for lending? Your lender can check with Fannie Mae and Freddie Mac to see if the condo you're interested in is on this list. And if the condominium is not eligible for standard financing programs, an explanation will be provided. Does the annual budget include a sufficient allocation for the capital reserve account? The capital reserve account is separate from the operating account and is meant to be used for future repairs or replacement of big ticket items such as the roof or heating system. The allocation for the capital reserve account should be at least 10% of the condo fees being collected on an annual basis. There is a provision for the amount to be less than 10% if the condominium has had a capital reserve study done within the past 3 years. A capital reserve study includes a calculation of the funds needed for future repairs based on the estimated lifespan of the big ticket items and the projected cost for each. If the condominium does not collect enough money to cover future expenses as part of the monthly condo fees, this will most certainly result in special assessments down the road, which could be very costly and burdensome for the homeowners. So here's an interesting fact. For condominiums with 4 or fewer units, a budget is typically not required. For these properties, Fannie Mae and Freddie Mac allow the homeowners to split the expenses on an as-needed basis. Here's another one. Does any single person, company, or other entity own more than 20% of the units? Now, if you buy new construction and the developer still owns quite a few units, then this is generally not an issue. But you will want to find out which percentage of the total units are under agreement with owner occupants and make sure that this number meets your lender's requirements. However, if you are buying a resale, then it's important to make sure that no single entity, meaning person or company, owns over 20% of the units. So, are there any critical repairs needed? If there are structural, safety, or health-related items that need to be addressed, the condominium may not be financeable until these are completed or resolved. You can request recent condo meeting minutes to see if there are any repairs being discussed. The condominium may also have a generic condo questionnaire that can be shared, and this may contain information relative to the result of recent inspections. Does the insurance meet lending guidelines? There are several important questions to ask about the master insurance policy, including, what is the amount of the deductible? It can't be too high. Many associations are looking for ways to avoid increases to condo fees, and one way is to increase the deductible on their insurance policies. They may not be aware that this could affect the ability for buyers and homeowners to obtain financing. If the property is in a flood zone, does the condominium carry a flood insurance policy that provides either the same amount of coverage as the property insurance policy or an amount equal to or greater than $250,000 times the number of units in the condominium? Are there any lawsuits in process involving the condominium? As a potential owner, this is something you would want to know. If someone is suing the condominium, does the condo have sufficient insurance and/or funds to cover a potential loss in court? On the other hand, if the condominium has filed a lawsuit, for instance, against the developer, what is being alleged and what would be the consequences, financial or otherwise, if they were to lose? Would they need to take care of the items included in the lawsuit at their own expense? And are there sufficient funds in the bank account to cover the cost? You may be surprised to learn that there are occasions when lenders do not do a thorough check that touches on the topics we've been discussing here. Depending on a number of factors, which can include the type of mortgage and the amount of your down payment, the lender may choose to do what's called a limited review, which means they won't be reviewing the budget or even requiring that a condo questionnaire be completed. The advantage to this is that it can speed up the process and make an approval more likely in a situation in which a full review could result in the loan being declined. But here's the catch. If the lender does a limited review, then it is even more important that you, as the buyer, conduct your own review. The last thing you want is any surprises after you take ownership of the condo that could present a cost burden or hinder your ability to refinance your mortgage or sell the unit. If you have any questions or would like more information, feel free to reach out to me at 781-910-9988. I'm Meredith Spence, the Mortgage Lady.